everyone, and welcome to another episode of Unscripted Equity Curiosity. This is Season 3, Episode 19. My name is Ami Joseph. I'm the Sector Head for Technology here at Hedgeye. With me today, as always, is Joseph Vatesplit, Director of Technology at Hedgeye. Andrew Freedman and Felix Wang are not available today. However, we have a special guest today, Daniel Biolsi, the Sector Head for Consumables and for Consumer Staples. Now, the series that we've been doing over the last 2 months is an introduction to different sectors for the uninitiated. And so today, Daniel, we're calling on you to help walk us through. Pretend that we are, newly minted institutional investors in your sector, and we don't know anything about your sector. So this is like the panic phone call, it's whatever day that I just get this assignment and I got to go figure this all out. And I don't even know anything about the sector. So let's start from the basics, and attack this however you want to attack it. But one of the ways we've asked this is top 5 most important companies in the space, or most important trends affecting the space, or the key things that when you discover them in one of these companies makes you excited on the long side, or vice versa, things that you see that get you worried and kind of identify, things that could be, good shorts. And so kind of that's sort of like a introductory category, but you can take this, opening however you want to take it.
Sure. Thanks for having me on. I mean, yes. Where to start? So I guess if you were calling me in a panic, the first thing I would say is to relax. It's consumer staples. So the good thing is that they tend to be, just steadier companies. These are not, there's a big distinction between the discretionary space and the consumer staples space, right? These companies are much, I think most people start with GDP, when or consumer spending when thinking about growth rates, not, compared to consumer discretionary where that wouldn't work at all, right? So it's you're looking at, for most part, low single digit to mid single digit, revenue growth, right? So your projections are going to be a lot steadier. Your modeling, even when you're off, isn't going to look as dramatic. You know what I mean? If you're looking for mid-single digits and then new low single digits, that's the margin between, winning and losing, right? So, but it's hardly a disaster as opposed to, a discretionary company where, you can overnight, be sort of out of business in 2 years. You know what I mean? So it's no reason to panic when you're looking at consumer staples. But so where would I start? I think where I start, let's just start with the longs. I think in consumer staples, that might be a little bit easier because I think shorts are generally sort of like the reverse. But for my longs, I start with secular growth. What company or what subcategory in consumer staples, has secular growth trends that you feel are tailwinds that you want to invest in, whether that's, caffeine is one for me, the increasing consumption of caffeine, because most categories don't have, very visible secular growth drivers, besides population growth, that's not sort of good enough, in terms of secular growth. So that's where I would start, pick a category in food or beverages or household products where you think you have a secular growth, and then maybe go to a company that you think is maybe winning share, right, in that sort of category. So if you picked caffeine, maybe for me it's energy drinks. So then that's sort of step 2. This is like a top-down way to look at it, right? If you were coming to me like this, most people don't sort of come with a mandate like that. But if you were, I think that's where I'd start. You have your what sort of subsector you want to bet on, and then if it's gaining share, so we'll do energy drinks in this example, and then within energy drinks, what are you looking at? Is it Monster or Celsius? These are companies on my long list, and then we can evaluate, is it a good investment? But I think that's where I would start.
So in that starting point. I already have some questions before we get to shorts or get the list of companies or whatever it is. But I guess my first question is on the secular growers, on like the subsector names, like what kind of growth do they do do they report on an annual basis? And is there a lot of M&A involved, or is this mostly like organic secular growth?
So there's a lot of M&A in the sector. So the one thing, I guess, stepping back a bit on consumer staples, different than discretionary is in consumer staples. If you look at the subcategories, when I'm talking about subcategories, it would be, instead of looking at all of food, looking at, let's say, cereal or frozen food or, breads or things like that, right? So subcategories tends to be dominated by two companies, right? And then you have your private label as your number 3 in terms of share. And then you have everyone sort of battling it out for, fourth place or just to be in there. And what happens is one of the two big guys tends to buy anything, sort of up and coming within that space to go for growth, because unit growth is hard to come by in my space. And that's generally been the case for the last 10 years, especially with, I think one of the headwinds for the space, the last, 10, 15 years is just the discount grocery taking share. So whether that's Walmart or, these newer companies like, or the dollar stores, or the newer companies like Lidl and Aldi, over time, what wins in grocery is, having the lower prices, or so it could also be warehouse clubs, right? So what tends to win is the lower prices. What's sort of an aberration is, the higher end, like a Whole Foods. So, there's only so much like that. Whereas as opposed to, discretionary, where you seem to hear about so many Whole Foods type brands, right? Like the higher end brands, right? That they seem to be winning in discretionary. In staples, the market size is much smaller. So what tends to win are the bigger companies who might go ahead and buy one of these new companies. So, the latest one we had, for example, was Sovos Brands. Don't know if you've heard of it. They have that Rayo sauce. So Conagra, Campbell actually went out and bought them, and they can, use their distribution and create a lot of synergies and growth, because they already have the manufacturing for the new categories and then the distribution into the retailer. So that's what tends to happen. And it tends to be a 2-horse race plus private label. So if you can create something new, kind of like, Annie's, then you get bought. If Annie's cheese, mac and cheese, you get bought by one of the big guys.
When the big guys are buying like an Annie's or somebody like that, is it cover your ass revenue? Like meaning like I'm going to miss the quarter and therefore I'm putting in some revenue? Or is it literally like it's too small to really move the needle on revenue? It's really just what you said, the vision of I'm going to scale these guys up from 50 million a quarter of revenue to 500 million and through my distribution.
It tends not to me to cover a quarter. I think that's in other sectors and staples that doesn't happen. It's really buying your growth, right? So that's different. Like that, it's that this acquisition, it definitely supplements your growth, because really, if you can go from low single digits to mid single digits, your multiple, goes, from let's say 12 to 17 times to something more like 15 to 25 times. So you can see why, if you can successfully sort of plug in these growth drivers, and you don't want to, that's the thing, is you don't want to buy something like Annie's if it's only going to grow 1 year. That's not what happens in staples. You're trying to buy this for a multi-year growth, like where it can sort of plug in into other categories for you, right? So, in Annie's, maybe, like the Sovos brands, like they're going to do a pizza, that they might do, lasagnas, like they keep expanding beyond just spaghetti sauce, and that's what works.
Okay, so then based on what we've talked about so far, if we're sticking with this sort of like this food area, what I would think to be long is, I would think that I'd want to be long one of the top 2 operators who I think is just really, really, really good. And they have the model down and it's not too expensive, but they accrete incremental, like they're, even if the top line only grows 5%, they're putting up like over 10% earnings growth per year easily. And maybe I have a dividend or a buyback in place, and I can just like steady Eddie that for like 6 or 7 years, and I get a market return or better than market return. That's number one. And the second thing, I'd probably try to guess at, who is the next takeout, who's the hot new thing that has to get bought, and, have a smaller amount of share, like position there, but with like potential more upside and also more risk, if they either grow really fast or they get taken out. A, does that sound right to you? And B, like if I'm trying to find my shorts there, like what's the inverse of all that? Is that like, do I short number 3 in the space, number 4 in the space? Like how do I build that?
Right. So I feel like the that Warren Buffett adage, like in consumer staples, where a good management team is more important, and the category also matters, right? So I would say that's a good starting place. I would insert competitive barriers to entry as being really important. So there are certain categories that, no matter how good of a management team you have, right, like it can't really overcome the challenges within the space. So, and then there are other sort of competitive sectors where that's going to be the inverse of that. So that might be where you look at a short. So for example, when you have inflationary pressures, you might have a different short thesis. And then I would look at, there's some categories that are going to be more prone to competition, and that competition, the one that matters more. So like there's always a battle between Coke and Pepsi, right? But what matters more is when private label gains share in your space, right? Then you don't have your pricing power, then you can have margin pressure, and now you have earnings misses, right? You have top line, that you could have misses on the top line. You could also have margin misses because you don't have pricing pressure. And some categories it's just the nature of the category where it's harder to raise prices. So for example, if you look at like soda, where you have, you're buying that can or that 20-ounce bottle, what it costs, right? It's the same size. You can't sort of make your can go from 12 ounces to 10, right? Like a bag of chips, the snacks, the indulgences like candy, they have very sort of low private label because that's not where you're really looking to save money when you're buying this. You're buying it, as sort of like a little bit of an indulgence, $4 little snack, right? Like in those cases, it's a lot easier to pass on pricing as opposed to something where it's always the same size and there's nothing else to do. You can't use, like the term is shrinkflation, where, you remove a couple diapers from the package of diapers. Like nobody remembers if you bought 96 last time or 92 and now the prices change and they're saying +6. You can't, it sounds like people get upset, but ultimately the consumer has always voted that they'd rather have it that way. And really you're just comparing it to, if you're looking at Pampers, you're comparing to Huggies, right? Like that's the thing. So it's much easier in certain categories, indulgent categories. It's a little bit easier. Categories where you don't know the exact size. So, a box of tissues, for example, you don't really know how many are supposed to be in there or the size of the tissue. There are a lot of different ways you can manage those margins, and people would rather you maybe remove a couple of tissues and keep the same price. Like I want $1.99. I don't want to pay more than that, that price figure. So I know those matter as well. So no matter how good of a management team you are, when you're trying to do that, it's going to be stuck in. So another example would be sort of commodities industries where it's really hard to raise prices. Think, a terrible category in consumer staples was milk or dairy, right? So they might go around, and then you talk about M&A, they would do acquisitions and try to grow that way and maybe buy growth each year, but it's still a very difficult industry. You're tied to agriculture, which is not where you want to be, right? And then it's sort of difficult to pass on prices. It's difficult to have a premium, brand, in dairy. You can't really think of national brands in dairy. It's those types of things that make it hard, and those are more prone to where I would sort of think about shorts. And then if you're looking at shorts, what is sort of changing, right? So that one, you'd have sort of a whole list of companies that you'd rather short than long. And then what else is happening maybe in the macro environment that might, make it the timing on the short side, as opposed to, like for example, in the pandemic, when everyone shifted to at home eating versus away from home, gosh, everything was along, right? Because all the volumes are going up. That was a time where, a dairy company would do better, right? Because now all of a sudden people, you know what I mean? So there's a timing for it on the short side, but there's only so much a great management team can do in some categories. And so I almost have a list of categories I just don't really like unless the conditions are right. And then there's categories where I like most of the time, as long as the conditions aren't wrong. Let's just say foreign currency. If let's say, for example, they might be sourcing their ingredients from another country, right? So, absent some of those, one-time sort of issues, then go long though. So I think that's the one way to think about the long and shorts.
Awesome. So if I'm thinking about, like, in the shorts conversation, we started with, you can be an amazing management team, but if the category can't hold price, right? This is, and you mentioned Coke and Pepsi. Is that, are they, so basically in your mind, you're sort of bearish on Coke and Pepsi, like, generally speaking. Can you help me understand the why? Like, what's the kind of like a general thesis, for somebody to be bearish on Coke and Pepsi?
I wouldn't say I wouldn't put those in the bad camp. But they do have sort of a bit of a headwind from not being and this is a sort of a very long duration, like, carbonated soft drinks, Coke, but they're not gaining new customers, right? So that's sort of you're doing it internationally, right? You're not doing it domestically, right? Like, people aren't drinking, cola more, right? Like, they're drinking other drinks. So are they transitioning to that? That matters more. But in this case, Pepsi is much more international. Pepsi is really the 800-pound gorilla in snacks. So that's really what's driving the investment thesis on both those two. Rather, I mean, of course, you're conscious of nobody is drinking more cola, but that's already sort of built into the model. The variances are international for Coke, or and then new product categories, and then for Pepsi it's snacking, and also new beverage categories that they're growing into. They have other sort of some categories besides like colas.
And they can't raise prices, like Coke and Pepsi can't raise. I mean, I know they have diminishing unit demand, but like, they can't raise price into that, or?
Oh no, they definitely are raising prices. They've actually passed on prices quite well in this environment, so that we haven't really seen much of a shift to private label. I didn't mean that in that case for those two. I was just sort of making an example. But right now they have very strong brands, right? Those are among probably the most valuable brands we have in consumer. So yes, they can raise price, but yes, you are especially now seeing a unit offset to that as well. So right now, the investment thesis for both is more about margin recovery, recapturing lost margins rather than raising ability to raise price or not.
Got it. Okay. And then you mentioned you can't have like a national, like, national dairy brand. Is that just like logistics of like getting things to places without, like refrigeration and all those kinds of things and all that, or?
Well, I think it's very complicated. I think it's sort of by nature. There have been public companies. Dean Foods was one. It didn't work out well. It's not like I don't want to say never. It's just, why would you bother? I guess this is my point. And the main, maybe short response to that would be, you're not going to be able to beat the grocer's private or store label milk brand. So much is purchased at the lower end that how can you do a national brand? You'd have to charge a premium, but what are you associating with your national brand that's going to beat the Walmart price? People are just going to buy the Walmart price, and it's going to have much larger share. And then, where's your supply? So you get what I'm saying, like that.
Yeah.
You're banging your head against the wall. Why bother doing it?
Okay. Got it. Okay. And maybe we could also, like, I mean, like, I'm really, like, actually very green in this area. What are the top 5 most important companies, or 10 even, in the space? You mentioned Walmart. I'm assuming that's up there, but
yes. So, like, if you wanted to take an example of like key bellwethers, if that's what you're looking for, I would say Walmart, of course, the largest grocer. Really, yeah, you really have to pay attention to what they're doing, right? Like right now, for example, Walmart is telling all their suppliers, don't raise price, don't even try. So you have to know what Walmart's doing, right? And then maybe you would have to add like Procter and Gamble, a leader in a lot of the household categories, the non-food categories.
Right.
I'd say that's up there. I'd throw in, I think Pepsi and Coke, if you just want to toss in one of them, let's just throw in Pepsi because it also has the food side, and they have one of the more dominant shares of snacking compared to, like, they dominate snacking more than most companies can dominate a single subcategory. So that might give you, color into what's happening there and the various inputs. They're also international, such that, anything happening in the world, somehow Pepsi is affected, right? If you're looking at that. And then maybe I'd throw in also Mondelez. It's in the same sort of category, confectionery and snacks, but it's very international. That was Mondelez. It was spun out of, Kraft, to spin out the higher growth, right? So you're thinking like emerging markets, right? And their snacking brands, their chocolate brands that the Europeans are much more familiar with their brands. They have US brands, but the brands are much more familiar with Europeans than US brands. But I think that would give you a very good grasp for what's happening internationally. And that's, of course, not of course, but there's higher growth rates for most of these brands internationally, than in the US, but not every company can do it, right? Like you need not every brand translates to different countries, right? So you already need to sort of be there, and otherwise it takes big investments. But Mondelez has those types of brands, and so that, I guess I would cover those four. And then if you want to add in like alcohol, and I'll skip tobacco, but if you want to add alcohol, I'd add AB InBev. Budweiser, has all these beer brands, and beer is I think it's a very good category, but where Bud is sort of lower growth. But I think that would give you a pretty good feeling, or the bellwethers of the category globally.
Awesome, thank you. If we were to include tobacco, by the way, do most people consider like tobacco still kind of like an active investment opportunity? Like, is that?
I think here, so in the United States, the reason why I haven't spent as much time is I think someone with a legal background has more to offer for U.S. tobacco companies than a consumer product analyst. But all the growth is international as well. In the U.S., you're also, you see these new competitive entrants, and there's new sort of forms of tobacco consumption. So that's what seems to matter more, and sort of between lawsuits and government actions, that's really what drives it, not the pricing versus unit, the elasticity. That's much more predictable than, but so it's a very different picture between the U.S. and an international. So all the excitement is international. In the U.S., I'd say it's more about like the illegal side, and then the dividend yield. I think a lot of U.S. investors own it just for the dividend yield, which, as we know, with the 10-year where it is, it's less appealing.
Or when you get into like valuation metrics for the space, is dividend yield like kind of like an important one, or would you start more with, you mentioned earlier moving from 12 to 17 times, I'm assuming you're talking about earnings, to 55 times. Is there any and is it GAAP earnings or is it non-GAAP earnings, or like what is the?
They use non-GAAP earnings, but there aren't really a lot of adjustments, right? Stock compensation isn't excluded from the non-GAAP earnings, right? Not like tech. It's very, there are of course charges and stuff, but I think it's pretty clean. It's not nearly as hard because you're not writing down lots of inventory. You're generally not shutting down lines of production. It's pretty straightforward, I'd say. So as a former accountant, I can attest to. I don't think the shenanigans are that high, right? Like they're not new things. You're not doing a lot of readjustments. What they tend to do is a lot of changing of segments. That's about it. But I forgot the first part of your question.
No, it's okay. It's okay. That's good.
Okay.
I was asking about like the key valuation metrics. And
Yeah. So the dividend yield, it matters because there is definitely a retail portion of investors in it, but I don't find that it's a very useful tool at all to predict, future performance. But you can't ignore, when the yield becomes high, that the stock stops going down as long as you think they could pay for it. But the dividend yields have been, probably lower than you would think. Like compared to maybe some of the companies you thought, you'd probably think an investor would need more than, let's say, 3% to be an attractive investment in some of my companies, right? But that's where it typically would have been, pre-pandemic for a not very fast growing company. And for a fast growing company, it might be just 1 or 2%, probably a lot. And so you can see why that is not very appealing at all.
Yeah,
with interest rates where they are now.
Yeah, with Philip Morris at 6%, and you're taking kind of like tail risk and all that. It doesn't seem that exciting.
You're right. And compare that to, all these other, whether it's REITs or utilities, you can see why it's not a very good tool. It's really just supposed to add to, if you can get, let's say, low single digit top line growth plus some margin expansion and then redeployment of capital, so you're getting like, let's say, high single digits to low double digits, EPS growth. And then if you could add a dividend yield, so you're looking at 12, 13%, that's sort of maybe the standard attempt or a growth formula, attempt and a growth formula. Not everyone can do it, right? But that I think would be considered, like a B, growth company, B plus. Of course, if you have higher growth, you're not going to have that dividend yield. But that's what I think a bunch of companies aspire to. And, that might not be all that exciting to a lot of other people. But I'll tell you, I've covered a consumer for over 20 years. Everyone starts off in discretionary just because it's so much more, the growth rates are so much higher. It's more dynamic. You have much bigger winners and losers. But, over time, when you get more gray hairs on me, you tend to appreciate, the company missed and it's only down 3%. You tend to appreciate those mornings as opposed to, the company missed, it is down 40%.
Right. Right.
So that's the difference in consumer staples. So I think you tend to find, and I have a hedge fund background, is that hedge funds are not as active in consumer staples. They're much more in discretionary. And then the bigger long only funds tend to be very large shareholders in consumer staples because you can put a lot of capital to work. These are much larger companies in general than like Brian's discretionary companies. Like if you just look at my list and just listed them, my companies tend to be several times larger. Just pick a middle of the list. My company is probably going to be, 3 to 5 times larger than his middle of the list company. Like he tends to be dominant, discretion tends to be dominated by a couple very large companies. And then, after Home Depot and Nike, the market caps get kind of small, but even, not so large companies in consumer staples can be, 10 billion. You'd be surprised by the size of some of the companies in consumer staples that you can make something so large out of, just a small category. But that's stability. That's your consumer staples side, and I think that's appealing to people. So like I'll give you an example. One of my top picks right now is Lamb Weston, ticker LW. It sells French fries, which is basically an industry dominated by 4 players, really just 2 players. And it's a $12 billion company and it just sells French fries.
You've
never heard of it, probably.
French fries to the grocery chains.
Well, they do, but it's much larger into the restaurants. So McDonald's.
Got it. Okay, so they dominate restaurant franchise, restaurant French fries. Got it.
Yes, and $12 billion for a French fry company that you've never heard of is my point. Like it can be quite large, and that stability is you can put a lot more capital to work, right, than you can. Yeah. Like if you're a big fund and let's say discretionary, you have a new fashionable widget. Well, how big is that going to get? Even if it does great, right? You can't put that much capital to work.
But I want to ask, maybe I want to ask that, like, I want to take what you just said and maybe turn it upside down for a second. Because Anheuser-Busch, I realized in 2023, they stepped on their own toes. And for those who missed it, we actually had Dan on earlier this year where we talked about Beer Wars. The title of the podcast was Beer Wars earlier this year. So if you want to understand a little bit deeper about what's going on there currently, please go access that podcast. But I guess my question for today is that Budweiser's stock basically peaked in 2016, right? So the 2023 problems were not even a glint in their own eyes. And it has descended. I mean, almost it's in half. Actually, it's more than in half now. But like even before the problems that we have, and even like, by February of 2022, sorry, they had descended, more than half of their market cap. And that's a decent amount of volatility for like a mega cap consumer staples where people put like a lot of capital, like you said, at play. So I guess my question is, how do you think about, and then I'm looking, by the way, at you said the caffeine drinks are doing really well, and I'm looking at Monster, and that's been a monster stock, but it's also a really big market cap. Like, at what point do you start to like say, like, what are the signals that Monster M&ST would show you that it's now copying what happened with Budweiser, whatever saturation, or why did Budweiser go down so much since 2015-16? And how do you take that and be like, okay, I'm going to go look for the next one that's going to do that?
Okay. So I think in the Budweiser case, let's just exclude the pandemic because that's sort of an unusual, and you understand that's a different challenge. But before that, I take you to AB InBev. Really, it was a 3G company, the Brazilian private equity firm that they sort of they implemented. What was it? What's it called? Zero-based budgeting. So what they went after. So that's a whole thing. That's where AB InBev comes from. So that the zero-based budgeting, it was created quite a firestorm in consumer staples where you would go buy companies that you considered fat and you would cut out excess. So so that made a lot of sense early on. You can get some returns. So if you think about Budweiser, this was a company that really dominated U.S. beer like anything else, right? It had one of the highest shares in their respective category as sort of any consumer brand out there. Less than a handful of companies dominated their category, like Budweiser dominated beer, like Nike dominated shoes. That's one of the other ones, for example. That's how few companies were like this. And there's sort of an aberration because of antitrust laws, right? But so there was a very fat company. It was so fat that, the family run, the CEO, in the family name, he would take a helicopter and land on their building in St. Louis, right? They had, cherry paneled offices. You can just imagine how gorgeous their offices must look. They must have had, I don't know, I'm just making it up, but like 20 box office seats, boxes, at the Cardinals games, right? Like they were just really a fat organization. And that's what this Brazilian company, targeted. And zero-based budgeting, they don't say, hey, your marketing budget was, $1 billion. Let's take it down 10%. They start with, what do you need? So if you only need, let's say 100 million, you can only make a case. The most American, companies tend to be, the variance from last year, right? That tends to be the starting place. So the 3G really instituted the opposite approach, and it had a ripple effect, throughout my industry for a good decade until at some point it does last because that's where your innovation comes from. You can't cut all this fat without cutting into your muscle, right? And that's what happened. And that's what happened to Kraft Heinz. They were there as well. So that's what they were doing to Budweiser. So I'll give you an example. In beer, if you're a real hop head, you would know that IBUs, internal bitter unit, is the sort of a measure of how much your hop content, your bitterness content in your beer, and hops are really the flavor in the beer, right? That's one of the key ingredients that changes the flavor. But 2/3 of the cost of beer is your packaging and your transportation. So think your glass bottle and, all of the trucking, fuel, et cetera, to get it to your grocery store, right? That's 2/3 of the cost. So hops are, relatively small percentage of that. Think of all the factory overhead, think, water, marketing, all that stuff. The hops are really a small smidgen, but it is the taste for your beer. And what they kept doing was every year they would ratchet down the IBUs from, I'm going to make it up, but from 20 to 19 to 18 to 17. So you ended up with a very bland tasting beer after a decade of this zero-based budgeting. And it doesn't make your quarter, because that's not where the cost comes from. You'd do a lot better if you could figure out how to stick more bottles into the same truck, right? Or reduce your route by, 2 blocks would have made more of a difference than your hops. But when you come at it only with the cost savings things, the consumer didn't know. Any year, you wouldn't have known last year. If you tried the Budweiser from 3 years, you wouldn't have known. But over time, and if you try something new, like a craft beer, you're like, wow, there is flavor. I've been missing flavor, right? So like, you don't know it year to year. No one in the office could tell, like, oh, I fooled the consumer. But when you're presented with a competitive product, that's when the craft beer started coming in. And this also was already in place before 3G got there, but 3G sort of accelerated this push. Budweiser was already doing this, but you can see why the barriers to entry in beer are high at the low prices, right? Like, it's hard. No one can deliver a beer sort of cheaper than Budweiser, but if you looked at Sam, if you looked at the Boston Beer, they're sort of the first big craft brewer. If you pull up that stock chart for 20 years, you can see that that's what I look for in consumer staples, right? So something where you had this huge tailwind of better tasting product that everyone knows so well, beer, and this was the representative of the category and how long that run rate was. So that if for example, if you bought that, the year I graduated high school, all the way up until, let's just say, pre-pandemic, I don't know, what you make 50 times your money or something like that over 20 years.
For Sam Adams, you mean?
Yeah.
What's the ticker on Sam Adams? Is that Boston Beer?
Sam. Yes, Boston Beer Company.
And then when something happened, like the COVID, just totally destroyed this.
Yeah, we'll leave that part out. Remember, I was shorted because of the hard seltzer. But if we just look at that sort of, like, that's what I'm talking about in terms of you could have just owned Sam, right? Boston Beer for that whole time, just on that one premise of craft beer taking share from these domestic brewers, right? So that's kind of what I look for. I think energy drinks are somewhere in the middle innings of something similar to that, right? Where what you're doing is you're converting children who drink soda, who have yet to drink, it's a new generation, this younger generation. They've been raised in Starbucks without drinking Starbucks coffee, right? They're not ordering drip coffee at Starbucks. They're drinking these frappuccinos laden with sugar and other creams. You can't even identify the coffee taste in it, right? Like, that's so they've been raised on that. You're converting them from a soda drinker to an energy drinker, so they're never drinking coffee, and that's how they're getting their caffeine. And by the way, our society is, the generations are, we're consuming more caffeine. Caffeine is how we operate in the digital world. It's harder and harder to to live in this fast-paced environment without little chemical help, right? Like, I liken it to, when I started in the business, I didn't have, I had a pager, right? I didn't have a cell phone. We didn't have smartphones. I didn't know what was happening in the world until I got into my office and sat at my desk, right? I had no idea. Maybe I turned CNBC on when I woke up, but there's that whole commute where I had no idea what was going on, right? So like, I have at least an hour of just waking up, right? Mentally. Now Yost has to respond to Omni's emails the second he wakes up, right?
Other way around.
But Omni needs this caffeine to operate in this environment. You need to be on like your iPhone's on.
Yeah. Yeah, that's interesting and intense. And just like, this is just a side question, but like, aren't like those caffeine drinks much worse for you than soda? Like in the end, like we're just replacing one bad thing with something much worse.
Well, I'm not professing to be a medical advisor for anybody, but I think caffeine hasn't had, I think there's a lot of movement, in a lot of different health ways. Like if you are on social media, there's someone who tells you everything I do is bad for me, but caffeine hasn't had the pushback, health-wise that a lot of other, you think of the four big chemicals in consumer staples. It's nicotine, it's alcohol, it's caffeine, and it's cannabis, right? So for legalized drugs that, what makes them so great, they're addictive, not, let's say, some cases just maybe mildly addictive, not like a real chemical dependence, but, those make great repeatable businesses, right? So caffeine is one where it's not frowned upon like alcohol and tobacco, right? But, and it's not nearly as hard to get off, right? But it's a habitual for sure, right? If you ask any coffee drinker, it's an habitual practice, and that makes for a great consumer staple.
So, okay, this is like a very good, like I want to stay with Monster for another second here. So like if the stock is $50, right? It's been as high as 60. If I want to get comfort with the fact that I think this is going to call it 250 over the next 10 years, let's say, right? That I'll look back and continue to see that chart the next 10 years. Like for me, I would have to figure out like some level, like you said, you pointed to middle innings. How do you get that comfort? Is that revenue related to peak InBev revenue? Is it percentage of people buying? Is it unit sales versus versus, I don't know, total Walmart soda sales? Like, how do you measure, what's the penetration curve? And how would you kind of think about where saturation is? Like, what number would you have to see that would make you have to take a step back and be like, ooh, I don't know about that. It might be getting towards the later innings of this.
Right. So yes, that's a great question. And, that's something that obviously really factors in, that's where we came out different for the alcoholic seltzers, for example. What is that TAM? So for Monster, a big reason why that TAM is just so much larger is not just domestic, it's international, right? So the penetration rates in international markets, and they give it to us, by various countries, is much smaller internationally. And, the US isn't even as high as some countries are. Red Bull is actually a very big competitor, but much more dominant share in Europe too. But it gives you an idea, what that unit penetration can be. So it's a little harder. It's a little harder to know. And I can't give you an example, a hard number of like, we are going to get to, let's say, one energy drink per American, right? I can't give you that number, but that pie, that TAM, and even in the United States, continues to grow larger. And part of that is form factor. So, you're thinking like that typical, can that you're getting at a 7-Eleven for an energy drink, you think it's pretty penetrated, but it's also that customer who's getting it, when they're 16, 17 at 7-Eleven continues to do that at age 30, right? Yeah. So you're converting them at a younger age, and you're keeping them, right? They're just not changing like our generation, Ami, of at some point stopping to drink Pepsi all the time and going to coffee. The younger generation increasingly is just staying on these energy drinks, but then there's different types of flavors or form factors. And what I mean by that is, it could be a coffee based instead of just a sort of a soda flavoring, or it could be zero sugar. So that's a new big sort of growth opportunity for them, as a lot of, for health reasons, you were asking about health reasons, but not having sugar in there opens that market to a whole new market, right? Like I am not interested in, I've been there, done that, in 20 ounces of like pure sugar drink, right? But zero sugar and has a lot more different flavor. There's, I think, day parts for that. So I think that's also what we're seeing, and that's why we're seeing even in consumers of energy drinks, you're seeing it continue to go up in terms of day parts, because if you think like coffee, the vast majority of coffee is consumed in the morning, and then a much smaller than you think percent of people drink maybe another coffee throughout the day. But energy drinks are not really by day part like that. There's a lot consumed late at night. We all know the nightclubs Omni's going to with the Red Bull and vodka drinks, right? So I'm joking, but you can see that so the day parts gives you an increasing TAM as well. So we haven't, every year we see that energy drink TAM grow larger, and that's part of the thinking. But I've done some estimates, back of the envelope, but I think it'd be wrong to stop and draw that in pen. Like every year, if you ask anyone 10 years ago, that we would have already exceeded the TAM. So I think you have to, keep that openness to the model.
Yeah. And it seems like the comparison to Bud is not a good one, because what happened with Bud is they were so focused on costs that they missed the inflection to flavor, or they kind of basically ruined their beer. And then the flavor opportunity took over a lot of market share, which started them going backwards in the first place. Whereas in the case of the energy drinks, it sounds like there's nothing today that is imminently disrupting energy drinks on people's on the grocery or 7-Eleven shelves or whatever, where the kids buy it.
And then, yes, I agree on the category energy drinks. You have, Celsius, which is also on my long list as maybe a little bit of a share gainer at the expense of everyone else. But the category itself is the disruptor to, I would say, soft drinks. So you're getting 150, 200 milligrams of caffeine. When I was growing up, Mountain Dew was considered crazy because it had 50, right?
Yeah.
And so that alone is going to give you a better kick. So once you convert from, Coke to Mountain Dew, and then Mountain Dew to energy drink, you're not going back. That's the whole reason why people went from regular coffee to Starbucks, right? The Starbucks has, triple the amount of caffeine as the Folgers and, that my parents were drinking, right? So you're not going to get that same caffeine benefit, right? So caffeine is a special element of this, but and then health reasons, younger generations are drinking less beer. They're also drinking different types. Not only just craft beer is actually probably peaked in terms of penetration, but you're seeing a whole new burgeoning category in different types of spirit-based drinks. The different flavor profiles. There's generational that. So I do pay attention, on a multi-year duration to things like Neil Howe would point out in terms of generations, right? How is the young, and then believe me, and this, that the companies are paying attention to, how is the youngest generation, adopting our brands, right? Are they adopting them in the same way? And in lots of cases, they're not. And you might not even notice this, but you probably would if I mentioned it. But like the youngest generations, they've grown up with the foods that you've been eating, so they're much more flavor forward, right? They're much more willing to try different flavors, and that's why you see so much innovation in flavors compared to us, right? So I remember when I was growing up, the big innovation for Pepsi was, one of them was clear soda, right? Now it's you should see all the different types of flavors they have for Pepsi, right? So you have to pay attention to that, and so beer happens to be, the share donor. I liken it to a leaky bucket, right? It's got a lot of holes. People are leaving the category every year. There's sort of no stopping it. You're going to be like that, the boy in the story sticking his fingers in the dam. That's what you're doing in beer and energy drinks. You're betting on so many secular drivers of the form of caffeine. You have the wind at your back. It's easy to make mistakes when you have time on your side. Awesome.
Gosh, we didn't even touch on all the stuff in the Procter and Gamble area, outside of food and all those trends. I'm sure there's stuff like shampoo. I don't even know, but like I imagined in medicine and shampoo and whatever, like there's probably a lot of interesting things there. But we're out of time today. We might have to have you come back on soon. This was a fantastic intro. And believe it or not, it actually makes me want to invest in consumer staples and like go like think about these things and read and do research and like think about it's just it does seem like there are these long tail trends that give you your shorts and your longs, like, and I think that's, I don't know, it's kind of interesting to me.
It is, and it's brands that are tangible that well. It's you can eat it yourself. You can see it yourself how it's there, and it's rare that things happen overnight like Bud Light. Like that's really rare. So companies are they're moving in some ways in slower motion. These trends are playing out in a much slower motion. Like you just can't accelerate energy drinks all at once like you can, let's say, with a shoe, right? Like everyone can wear a new type of shoe in 2 years, right? But you're just not going to get these types of trends in food. Just like think of like what you're eating, like sushi. How long did sushi take to be sort of adopted, right? These things take time. And so that time's on the side of a good consumer staples long.
Awesome. Daniel, thank you so much for coming on the show. To all our listeners, this has been season 3, episode 19 of Unscripted Equity Curiosity, a Hedgeye podcast that is freely available to you, as you know, since you're listening to the end of this, available on Apple or Spotify, and always available on my Twitter account, my X account at Hedgeye Tech is where we post these on Saturday, usually on Saturday mornings. Thank you so much, and we'll see you next time.
Don't forget to check out Hedgeye.com to get more actionable investing insights from our team of more than 40 research analysts. And check us out on Twitter at our handle, @Hedgeye. This presentation is informational only. None of the information contained herein constitutes an offer to sell or solicitation of an offer to buy any security or investment vehicle, nor does it constitute investment recommendation or legal, tax, accounting, or investment advice by Hedgeye or any of its employees, officers, agents, or guests. This information is presented without regard for individual investment preferences or risk parameters and is general, non-tailored, non-specific information. This content is based on information from sources believed to be reliable. Hedgeye is not responsible for errors, inaccuracies, or omissions of information. The opinions and conclusions contained in this report are those of the individual expressing those opinions and conclusions and are intended solely for the use of Hedgeye subscribers and the authorized recipients of the content. All investments entail a certain degree of risk, and financial instrument prices can fluctuate based on several factors, including those not considered in the preparation of the content. Consult your financial professional before investing. The information contained herein is protected by United States and foreign copyright laws and is intended solely for the use of its authorized recipient. Access must be provided directly by Hedgeye. Redistribution or republication is strictly prohibited. For more detail, please refer to the terms of service at hedgeye.com/terms of service.